$38 trillion, that is the current U.S. national debt, not projected, not hypothetical, but real and growing as of this year. And while headlines focus on politics and inflation, something far more serious is happening quietly behind the scenes. The world's largest financial institutions, including BlackRock, are moving money, not headlines, not rumors, capital, quietly, confidently, and without asking permission. This is not a panic. It is a pattern, one that has played out with every fallen empire before this one, and now it is unfolding again in plain sight. U.S. national debt surpassed $38 trillion by the end of 2025. That is more than the GDP of China, Japan, Germany, and the United Kingdom combined. It is a number so large that it stops feeling real. But the consequences are very real. Interest payments alone now exceed $1 trillion per year, more than the budgets of Medicare, national defense, or most government agencies. This is not just a balance sheet issue. It is a structural weakness, and most people do not feel it yet because the system is still working. Markets are still open. Dollars are still accepted. But history tells us that once debt grows larger than growth itself, the system changes. Quietly first. Then suddenly, America has reached a point where it borrows to pay the interest on what it already borrowed. That is not leverage. That is dependency. And this is not just about government debt. Corporate debt has ballooned. Consumer credit continues rising. Student loans, auto loans, medical debt, all growing at rates detached from average income. Total U.S. debt, public and private, surpassed $100 trillion. Over 370% of GDP. No major empire has sustained that level for long. Spain collapsed at 200%. The Dutch at 250%. Britain at 130%. America stands far beyond those thresholds. But because the collapse has not happened yet, it still feels invisible. That is how all patterns begin, visible only to those who look one step ahead. And increasingly, those who see what is coming are quietly moving out of the way. Empires do not collapse in a single moment. They follow a rhythm, a mathematical cycle that has repeated itself over centuries. Every reserve currency in modern history has moved through the same 4 stages. Spain, the Dutch Republic, Britain, each began with dominance, peaked in confidence, and fell into irrelevance, not by war, but by policy, timing, and math. Stage 1 is ascendancy. A single country becomes the center of global trade. Its currency becomes the reserve of choice. Capital floods in. Wealth builds. Confidence is absolute. Institutions grow. Banking, finance, infrastructure, influence. Stage 2 is overextension. Success breeds excessive spending. The government expands programs it cannot afford. It borrows to maintain a standard of living it no longer earns. Inflation begins, but is ignored. Asset prices inflate. The illusion of prosperity replaces real productivity. Stage 3 is the exit, quiet and deliberate. Those who understand financial risk, sovereign wealth funds, major asset managers, global banks begin reallocating. They reduce exposure to the system, not with press releases, but wire transfers. Debt is sold. Alternatives are explored. Stage 4 is collapse. The system loses its reserve status. The currency weakens. Trade moves away. The institutions built on confidence begin to fail simultaneously. Real estate, stocks, banks, bonds, all reprise downward. The middle class is hit first, then everyone else. This pattern does not rely on opinion. It relies on mathematics, interest rates, debt ratios, capital flows, and right now. Every major indicator shows the United States is in stage 3, not at the beginning, not approaching. Inside of it, and if history has taught us anything, it is that stage 4 does not wait for a warning. When a system starts breaking, the smartest players are the first to leave. They do not hold press conferences. They do not warn journalists. They read the numbers and they quietly change direction between 2013 and 2025. China reduced its U.S. Treasury holdings from over $1.2 trillion to $760 billion. Japan, once the top foreign holder of U.S. debt, cut its position by more than $220 billion in just 3 years. Other nations followed. Saudi Arabia, Switzerland, Belgium, France, one by one. They decreased their exposure to U.S. financial instruments subtly but consistently. Even the Federal Reserve itself began shrinking its balance sheet through what is known as quantitative tightening, choosing not to reinvest maturing bonds. Liquidity has begun to drain from the system, not through panic, but through policy. But this is not just about countries. It is institutions. BlackRock, the world's largest asset manager, has quietly rebalanced its portfolios, increasing stakes in foreign infrastructure, emerging market debt, global commodities, and hard assets. J.P. Morgan, Goldman Sachs, Morgan Stanley, and Bridgewater have followed suit with cautious diversification, reducing long-term U.S. Treasury exposure across sectors. The signs are not dramatic, but they are decisive. This is not capital fleeing a fire. This is capital relocating from a house that looks safe, but smells of smoke, and like every empire before this one, the exodus always begins before the collapse becomes obvious, because the institutions closest to the core always move first, everyone else follows later. When a trillion-dollar institution moves, it is never random. BlackRock, the largest asset manager in the world with more than $10 trillion under management, does not gamble. It positions over the past several years. It has quietly shifted to $0.1 trillion in capital out of U.S.-centric investments, not all at once and not all in one place, but the direction is clear. What was once concentrated in dollar-denominated bonds, real estate, and domestic equities has increasingly moved toward European infrastructure, emerging market debt, natural resources, and commodities. Gold and global cash alternatives. This is not a retreat. It is a rebalancing, the kind that large institutional players make when they see long-term risk building beneath the surface. BlackRock's internal strategy documents have referred to global liquidity, fragility, and sovereign risk convergence, coded language for growing concerns about the reliability of systems once considered permanent. This is not about politics. It is about preservation of value across cycles. BlackRock's moves are often a leading indicator for other institutions. Its allocations shape pension funds, foundations, and sovereign wealth behavior across dozens of countries, and right now, its message is clear. The United States is becoming overexposed, not worthless, but too concentrated, too indebted, too fragile on a long horizon. For the average person watching the market go up, these moves go unnoticed, but for anyone following the pattern, BlackRock is not just adapting, it is preparing. Stage 4 is the moment when gradual becomes sudden. Currency confidence slips. Foreign holders begin to sell, not out of hostility, but out of necessity. Trade agreements shift. Oil contracts start settling in other currencies. Payment networks evolve. And the dollar, while still usable, begins losing its global primacy. This does not happen overnight, but it always happens faster than anyone expects. As demand for dollars fades, those dollars currently held abroad come home. Trillions begin to circulate inside the domestic economy without new productivity to balance them. That surge triggers inflation, not 5%, not 10%. Uncontrolled, the Federal Reserve then faces a trap: raise interest rates dramatically to contain inflation, which would instantly spike borrowing costs and crash asset markets. Or continue printing money to keep credit flowing, which would weaken the dollar further and fuel even more inflation. Both options lead to loss of purchasing power, of savings, of trust. This is where banks begin to fail as loan books implode. Pension funds find their real returns devoured by inflation. Home values fall as liquidity dries up, and the middle class, typically anchored in cash and retirement portfolios, watches quietly as decades of wealth disappear in months. It is not visible until it is irreversible. History shows us that when confidence breaks, action follows, and in stage 4, there is no shelter inside the system that is collapsing. Only outside positions offer protection. If the world's largest institutions are repositioning, it makes sense to ask what individuals should do first. Understand this clearly. This is not about panic. it is about preparation. If your wealth is entirely tied to dollar-denominated assets, savings, stocks, pensions, you are exposed to the same risks these institutions are insulating against. Start with diversification. That includes assets with intrinsic value, gold, commodities, and productive land. These instruments do not rely on a functioning currency system to preserve value. Geographical diversification matters, too. While not everyone can move capital abroad, you can learn how capital behaves in stronger monetary systems, currencies like the Swiss franc, Singapore dollar, or Norwegian krone backed by sound fiscal policy. Maintain access to liquidity. In a credit freeze, cash, even in a depreciating form, provides mobility and opportunity. A bear market is devastating to the unprepared, but potentially life-changing for those with resources ready. Reduce debt wherever possible. In an inflationary world with rising interest rates, servicing loans becomes harder, and assets tied to leverage can unwind quickly. Finally, invest in skills and relationships, the most resilient forms of capital. In any transition, people who can build, solve, and lead remain valuable, regardless of what the currency is called. This is not about beating the system. It is about not being buried under it when it shifts. Every empire believed it was different until the pattern caught up. Debt grows, trust erodes, and capital moves. Quietly first, then all at once. Today, the data is not hidden. The decisions are public. The shifts are happening in plain view. And still, most will only ask questions after the consequences arrive. But those who study patterns across history, across markets, across nations, are not surprised. BlackRock did not call a press conference, they simply moved. And now the question is not whether the system will change, it is whether you will change before it does.